Welcome to The Explainer. Today, we're digging into a real puzzle from the stock market, all centered around Beyond Meat. Now, this is a company whose financials basically scream stay away, but its stock price, well, at times it's acted like an absolute rocket ship. So we're going to figure out what's really going on here.
And this really is the central mystery, isn't it? I mean, think about it. How on earth does a company's stock price just explode? We're talking over 500%, when by all the usual rules of investing, the business itself looks like it's in serious trouble.
And this chart, wow, it paints a pretty stark picture. On one hand, you have over $1 billion in debt. On the other, just about $170 million in cash. You know, imagine if your credit card bill was 6 times bigger than all the money you have in the bank. That's the kind of situation that usually has investors heading for the hills.
Okay, so to solve this whole puzzle, we've got to start with the basics. Why should this stock be struggling? Well, our source material points to some fundamental red flags that are, frankly, impossible to ignore. First thing you have to look at is that mountain of debt. It's over $1 billion. To give you some perspective, at times, the company's entire value on the stock market has been way less than what it owes. It's just like taking out a mortgage that's worth way more than your house. It's not a good look. And it's not just about the debt. Take a look at sales. They're actually going in the wrong direction. The business isn't growing. In fact, our source shows that revenue has been consistently dropping. Simply put, fewer people are buying their products.
Then, on top of all that, there's something called shareholder dilution. See, the company keeps creating millions of new shares out of thin air. It's kind of like, imagine the company is a pizza. Every time they issue new shares, they're just adding more slices, which means your original slice gets smaller and smaller.
So, let's just recap for a second. You've got huge debt, sales are falling, and your slice of the pie is shrinking. When you put all that together, it's really no surprise that our source's conclusion on the company as an investment is, well, let's just say it's brutally honest.
All right, so if the company looks so bad on paper, how in the world did the stock go to the moon? Well, this is where the story takes a sharp turn. We're leaving the land of normal, long-term investing and stepping right into the wild world of short-term speculation.
And it all starts with this idea called short selling. Now, I know it sounds complicated, but stick with me, it's actually simple. Imagine your friend has a rare comic book that you think is about to become totally worthless. You borrow it and you sell it today for $100. A week later, you were right, it's worthless. You buy it back for just $10. You give the comic back to your friend and you walk away with a $90 profit. That's short selling. It's a bet that something is going to fail.
So, to spot a situation where this could all blow up, you got to look at 2 key numbers. First is the short float. That just tells you how many people are betting against the stock. But the second one, the short ratio, that's the real kicker. That tells you how long it would take all those people to get out of their bets if things went wrong. Think of it like this. It's not just knowing how many people are in a movie theater, it's knowing how small the exit doors are.
And that's exactly where the trap gets set. See, if it takes a really long time for those short sellers to get out, if the exit doors are tiny, they are completely vulnerable. If the stock price suddenly starts going up instead of down, they all panic and make a mad dash for the exit at the same time. But here's the insane part. To get out of their bet, they are forced to buy the stock. They get trapped.
So now we can put all the pieces together. We have the perfect recipe for what's called a short squeeze. And what's so ironic is that the company's terrible financial situation is actually the main ingredient that makes the whole thing possible.
What happens is this crazy feedback loop. The terrible fundamentals attract a ton of people to bet against the stock. Then some unexpected good news hits and the stock ticks up just a little bit. That's when the panic starts. The short sellers are forced to buy the stock back to stop their losses. And that wave of forced buying creates this massive demand that sends the price absolutely soaring, which, of course, traps even more short sellers. And if you look at the actual numbers for Beyond Meat from our source, you can see this isn't just a theory. Back when the stock had that huge 500% squeeze, over 60% of its available shares were being bet against. And crucially, that escape route, it was super narrow. It would have taken anywhere from 5 to 11 days for them to get out. The trap was perfectly set. Now look at today. The number of people betting against it is rising again, but that escape time is still pretty low. So the trap, well, it isn't armed just yet.
So what does all this mean for what might happen next? It's so important to understand the massive risks involved here. Our source is really clear about this. What we're talking about is not investing. This is a high-stakes gamble, plain and simple.
You have to remember, when you're playing this game, you're not just betting on a squeeze to happen. You're betting against the clock.
The company could literally go bankrupt and poof, the stock is worthless. They could keep issuing more shares, making your stake worth less and less. Or they might have to do something called a reverse stock split, which is usually a last-ditch effort to just stay listed on the stock exchange.
But this is where the logic gets truly bizarre and flips on its head. Our source points out that this reverse stock split, which is a giant red flag that the company's in trouble, could ironically make a squeeze more likely. A move born out of desperation could inadvertently make it even harder for short sellers to find shares to buy to get out of their positions. It could actually be the move that primes the trap. It's absolutely wild stuff.
So really, the final takeaway here is to see this for what it is. It's a gambit. It is not a sure thing. You have to be extremely careful because while you're waiting for that potential squeeze, the company's terrible fundamentals could drive it right into bankruptcy. You have to be prepared to lose everything.
And that really leaves us with this final big question. The Beyond Meat story isn't one story. It's two completely different games being played on the same field at the same time. You've got the game of fundamentals, profits and sales and debt. And then you have this other game of pure speculative mechanics. And maybe the most important rule of all is making sure you know which game you're actually choosing to play.